Today, we're talking about life insurance. What even is it? How did it get started? We're going to talk about it. What's up, folks? My name is Dallas. I am a financial professional helping small businesses and individuals with their retirement planning and just their overall financial picture for the future. One of those things of which is life insurance. It's a key component of someone's future and financial situations for both them and their family, of course. That's, life insurance, passing on money. There's a lot of things you can do with life insurance. There's term insurance, whole life, universal life, variable universal life, and index universal life, to name just a handful there. There's a lot of different reasons to have one. You can have it for passing on money, to take care of burial expenses. You can have it to cover the cost of a mortgage if you pass away prematurely. There's a lot of different tactics and strategies. But today we're going to talk about kind of the history, where it came from, and then some of the modern benefits that you can actually have with life insurance. It's thought that the original type of life insurance was actually formed loosely in the Roman times when they had burial and funeral societies / clubs that you could join. It's kind of like a membership thing, and a lot of those fees and stuff would go towards helping a member once they passed away. Families would pay for musicians and actors, and it'd be a whole week-long thing, a big event that would cost the family a lot of money. So you would then have to come up with the funds to do that. These burial societies and clubs actually helped to give money for the family to provide all these different things when someone were to pass away. Fast forwarding a little bit in history to the 1500s, the first official written type of life insurance is known to be from London, England in the 1500s on a man by the name of William Gibbon. He owned a fish and meat market, and his best friend Richard Martin was the beneficiary. He had a life insurance policy that was actually written out on a contract and was able to be paid out upon his death. Moving forward through time, specifically pertaining to the United States and where we are today, in the 1700s, the Presbyterian Church developed a fund for ministers to help with burial expenses and whatnot. And that created the trend in Pennsylvania in the 1700s to start to develop life insurance as we know it today. Fast forward through time again, life insurance took a whole nother swing in the mid-1800s, and it became more of what we see today in the form of whole life, and eventually term life, and then universal life, variable universal life, and index universal life. That's one of the more modern iterations that we have today. There's obviously a lot more details in between all of that, and I'm not really exactly sure what the audience would want to learn or know. So if you have questions specifically about kind of what life insurance looked like in between those time frames and more in depth, let me know down below, and we'll be sure to make a video about it. For this video and for today's purposes, we really want to cover kind of a couple different things. Whole life, a lot of people have heard about whole life. What is it? How does it really operate? Term insurance, and then what I like to use in the form of an indexed universal life, and what those three kind of options really mean for you. Let's start with the more simple one, and that is term insurance. Term insurance is exactly how it sounds pretty much. It lasts for a certain term. You can have a 10-year term, a 20-year term, sometimes a 30-year term, or it can be a term that lasts to a certain age, depending on the provider and what exactly you have going on and what your desire is. There are several different types of term policies, most of common which are 10-year, 20-year, and 30-year contracts. Think of it kind of as renting. The cost typically, in this day and age, I guess this analogy doesn't quite work, but the cost is way less for term insurance than it is permanent life insurance. And it simply covers if you pass away, there's a death benefit, and there's no cash value, there's no interest earned, there's no extra florals or any fancy stuff. It's simply insurance, and the cost of that insurance is fairly cheap. Personally, I like to use term insurance in addition to permanent insurance, because oftentimes we're using permanent insurance for other benefits that would potentially deplete or reduce the amount of insurance that would actually be passed on because you're using it while you're alive. And if you want a specific amount of insurance to pass on, it's good to have a little bit of a term on top of the permanent plan that you have, really just depending on what your goals are, or what you're trying to achieve for you and your family as life goes on. Now for whole life, and we're kind of going with the Reader's Digest version today. Like I said, if you want more in-depth video or in-depth information about all these exact things, let me know down below, and that way I know what kind of videos to make for you guys. But whole life is kind of exactly what it sounds like for kind of opposite of term life. It's life insurance for your whole life. There's usually fixed rates. In modern times, there are availability to have a little bit more interest than just a fixed rate. But it's really designed for the cash value that's building inside of the account. Unlike a term insurance, the cash value earns a little interest, and it's mostly designed for that cash value to cover the cost of the insurance for the rest of your life, so that the insurance is there for your whole life. That's kind of where the terminology came from. You can see the correlation there. In recent history, 20, 30, 40 years ago, people started taking money out of the cash value. They saw that as an additional savings, but a lot of them got in trouble because they found out they took out too much and the policy lapsed. Therefore, life insurance now in modern times actually has a really bad name because of those exact events, and I don't blame them. The concept of whole life was never really designed, based on what I can find and based on my knowledge, it was never really designed to take money out. That's why we have new iterations of life insurance, and the universal life, which is a little bit more flexible than a whole life. It's kind of like a step up. Then we have the variable universal life, which is a universal life that is variable depending on the stock markets, which there's pros and cons to that. And then what I like to use most is what's called an indexed universal life. So we'll talk a little bit more about indexed universal life. Again, let me know down below if you want to learn more in depth about some of those other items. An index universal life uses what is called indexing strategies with different allocations, and you're going to earn interest on the upside. So for example, if the S&P 500 went up 10%, average 10% over this next year, you would probably have a cap rate of 8 or 9%. So you'd get 8 to 9% of that 10% growth. But then if the next year the S&P 500 went down 20%, you would stay level. You wouldn't lose anything. You're not really making anything, so you would just stay level. So no, you're not getting the full value of the S&P 500, and it's not like you're seeing interest earned every day, every month, like a typical stock type account or mutual fund or anything of that nature. Interest is generally based on monthly or annual credits, and it just takes the average of the different indexes that you're using. S&P 500 is the most common. That's the one I like to use mostly because it's kind of the best currently in this day and age. But interest is earned based on the upside with the guarantee no loss when the market does go down. So in addition to that, you have the insurance component similar to the whole life. Half or less of what you're contributing to the policy is actually going towards the insurance amount. And then that insurance amount, depending on what you're wanting to accomplish, can be leveraged as a loan to take out tax-free in the future. So you're going to have your cash value. It's going to grow with the upside of the market and then the insurance amount. And you'll be able to take out however much is in the cash value against the insurance amount. So if you have $100,000 in the cash value, you'd be able to loan out $100,000 against the $200,000 insurance amount. And these are just rough numbers, just a rough explanation to present an example, okay? So you'd be able to loan out $100,000. I always say take 90%, so maybe let's call it $90,000 just to leave a little bit behind to cover the remaining cost for the insurance so that it will be there forever, similar to the whole life. But that $90,000 would then come out of the $200,000 when you were to pass away. So your family would be left with $110,000, which is why I said if there's a specific amount of insurance that you want to pass on, it's good to have an additional term on top of the permanent plan, just in case. The older you get, the longer you go in life, the less need for insurance there typically is. Again, every situation is different. Every case is a completely different goal set for that individual, for that family. So it really just depends on what you want to achieve, what kind of time frame you have, and where you are today versus where you want to be in the future, right? So that's kind of just a quick rundown, a quick breakdown as to the different types of insurance, term insurance and then permanent insurance. And within the permanent insurance side, the most common is the whole life and then the index universal life, which I'm going to do a whole nother video on index universal life. There's a lot of misinformation out there today, and I want to kind of help clean the air. There's a lot of other creators, content folks, whatever. I don't really consider myself that, but there's a lot of other individuals out there putting out really good content about IULs, and then there's a lot that are not. So, but anyway, I hope you learned something from that today, and we'll see you on the next one.